Base interest rates on standard savings accounts in Singapore are as low as 0.05% per annum. But many banks offer high interest options, where savers can earn bonus interest as long as they carry out qualifying banking transactions. These rates have been trending downwards. From September 1st, the best available maximum effective rate for customers who credit their salary and spend a minimum amount will be 3.05%. Despite the cuts in headline rates, these high-yield savings accounts could still offer some of the best returns for those looking for low-risk options. That's if you meet the requirements needed to qualify for the higher yield.
The overall economy's interest rates falling, so all of the banks will also have a decrease. So instead of just focusing on the headline interest rates, you should look at the categories that you fulfill, because ultimately for most of these accounts, you have to fulfill several categories to get the enhanced interest rates. So I think practically speaking, if for example you look at your how you plan your finances, you have certain bank loans, investments or insurance with a certain bank, most likely if you choose that same bank's savings account, you'll get the very enhanced interest rate. Conversely, if you don't really use any of these kind of investment products or bank loans, and you want a very straightforward, just salary credit and maybe some kind of card spend, so some of these banks have a simplified kind of category, so you can choose those kind of accounts.
And there's usually a cap on your deposits that earn the enhanced interest rates.
A lot of these multiplier accounts, they only give you the higher interest rate on, say, maybe your first 100,000, your first 150,000. Anything other than that, right? It goes back to the flat rate, right? You don't get that multiplied high interest rate. It's about having your money work for you, not you working for your money. So in line with that, when it comes to all this high yield savings account, you don't want to make too much changes to your spending habits, to your life.
If you don't meet the high yield requirements, there are other low risk options to optimize your savings, but the returns may be lower. The August issuance of the Singapore Savings Bonds offers a one-year interest rate of 1.71%. However, the 10-year average return is 2.11%, which means this could be a good option for locking in a relatively higher rate.
SSBs are a very, very good option for retail investors. It's very low, no risk, backed by the government. It's very safe and transparent. It's easy to apply for as well. You can do through iBanking. And also every month there's a new option. Yeah, so I think, and it's very transparent. You can see your 10-year yield and you can withdraw at any time. There is a bit of processing time, maybe like per month, but it's still a very liquid kind of investment. So I do think as a base, if anybody has access, disposable cash, you should park it into SSBs.
Fixed deposits are also a relatively safe option to park your cash. Although fixed deposit rates have continued to decline, there are promotions you could look for.
Usually there are some kind of promotional fixed deposits, for example fresh funds. Usually some banks offer this when you deposit fresh funds, you get quite a high interest rate from certain fixed deposits. So if you have fulfilled this kind of requirements, you can consider that. It tends to be higher than just your average savings account.
There is also the option to top up one's CPF for guaranteed interest rates starting from 2.5%. But this does come with a liquidity trade-off.
CPF will definitely be on my list as well, given that you are able to enjoy a higher interest rate. And if you top up your CPF, especially if you top up CPF of a loved one, you actually do get to claim some sort of a tax relief on it as well. The biggest downside is that it's lock-in period, right? The lock-in period, you don't get to see it until you reach your retirement age.
For those who have maxed out the bonus caps in their high interest rate savings accounts, money market funds could be an option.
They then tend to offer slightly higher yield than the savings accounts, and also T+1 liquidity. And it's a professional fund management, and you cannot access these sort of certain like MAS bonds by yourself, so it's a good choice. The main benefit is that they are relatively low risk and it's usually T+1 liquidity, so you can get your money back almost like in the next working day. So as compared to T-bills, which definitely will have a lockup of 6 months, they follow the larger interest rates, yes. So it fluctuates, it's not fixed. And the other thing that it's not SDIC insured, so there is a risk. It's considered more of an investment rather than a bank deposit. Yeah. So there's a small risk, but I think still most investors will use it as of like a short-term cash parking vehicle.
If you have idle cash denominated in US dollars, you could also consider USD fixed deposits to earn a higher yield.
If you're an investor in US stocks, you may already have some kind of USD in your account, your multi-currency account. So this may be one option for you, especially if you don't want to deploy your funds into the equities market. You can choose a USD time deposit because it will attract a higher interest rate than just your SGD time deposit. For like a retail investor who does not have USD and they choose to do this, there will be a much more higher risk. You may not understand the risks that are involved. Because the FX rate itself may actually wipe out your higher interest rate, because it fluctuates and it's way beyond your control.
The declining yields on savings accounts reflect the overall trend of falling interest rates.
I think interest rates are going to come down. It's only a matter of when they're going to come down and by how much they're going to come down. You want to lock in the current interest rate at a longer period of time, so you at least know that your money is growing at a steady pace, right, over a longer period of time.